Hello, everybody. As always, it's very nice to be here with you. I'm glad to present a special guest we have today, Emilio Pérez. He's going to help us to learn more about the stock markets and bond market.
Well, hi, Oscar. It's a pleasure to be here in your podcast. In your podcast is one of the more famous podcasts that talks about economy and investments. So it's I'm really glad to be here. So thank you.
Thank you very much, Emilio. Mm, First of all, why is it that the majority of times the bond and the stock market have an inverse relationship? Could you help us to explain this?
Well, yes. First we need to talk about the risk between these two different markets and the relationship that they have between them. So you see, the stock market has a very high risk. So since he has a very high risk, he has a very high reward. And so in comparison to the bond market, it is not the same. You see, and the bond market is pretty much the opposite because it's a pretty safe market, but it has very little return of investment in comparison to the stock market. So the bond market is a safer investment than the stock market.
Okay, so we can say that if I were a risky person and I would like to have a good returns, no matter it's risky, I would prefer stock market. And if I don't want to risk, so bond will be a better option.
Yes, you're correct. So you get the point.
Thank you very much. Sounds great. And could you describe what is not the case in this time of the year? What are what are the bond markets expressing about the currency economic conditions?
Well, first we need to address something. You see, today and age, they're saying that we are entering a recession, but more than a recession, I can say that it's more like a market correction or a change. This is due to the fact that in this time of the year, the investors or the big companies are trying to cash their money back. So this is why this happens, and we can see this in the change of market.
Okay, and the pandemic could be a fact that affect.
Yes, yes. The pandemic has these certain things.
Okay, so inflationary expectations are lower than expected. What effect does this have on the economy? How would you expect bond yield rates to react to this?
Well, we need to understand that this happens, and when this happens, that inflationary expectations are lower than expected. The market stays like froze in a way, and we can see this in an inverted yield curve, and therefore in strange situations, in a
Okay,
way, severe economic slowdown or a recession, as we talked about. So the best use of this yield rate is to try to make sense of our economy's future. So you can tell by the yield rate the economy's future.
thank you very much. The last weekend, I heard two people talking about Fed's monetary rate policy. What has changed about it? And does these changes could affect the stock market?
Well, as you say, there have been a lot of changes at the FAD policies, but in my opinion, the most important is that there is no more security in buying this. So this means that the money is not as easy to get than before, and this will make the rates go up exponentially in comparison to other years.
Okay. So you are of the idea of following the bond market. Could you explain us why do you believe that following is better to following the bond market?
Yeah, well, as I said in the beginning of the stock market and the bond market, they move in different directions. So the way I see it is when the stock market is up and the bond market falls, and this goes either way. We need to take note of this to take advantage and take note of these changes to help us. So that's all.
It's awesome to hear things about from experts. Emilio, thank you very much for being here and thank you for your time.
No, thanks for having me. It's been a pleasure.
It's a pleasure and see you. See you
See
soon.
you.